This video covers the efficient market hypothesis. In this lecture, we'll introduce the concept of the efficient market hypothesis and its implications for investment management style and trading strategies. And also, we're going to introduce a set of evidence as tests of the efficient market hypothesis for the three different forms: the weak form, the semi-strong form, and the strong form EMH. Finally, we are just going to discuss the caveats in interpreting the evidence that's against the efficient market hypothesis. With the first test, by the way, I forgot to define that because we find a lot of evidence that seems to contradict the EMH, we have created a new word, right, in finance literature. It's called anomalies, financial anomalies. So what is financial anomalies? It is evidence that's against the CAPM or the EMH that's not consistent with the predictions out of the EMH, and then we call all those return patterns non-financial anomalies. Okay, so keep this in mind because this is a very important concept for you, especially when it comes to the test. Okay, so before I move to the first test, I want to give you a little question here. So the question is, I want you to send me your answer to those questions. Maybe I can do a little questionnaire. I'm not sure whether I can do the poll. Okay, I'll try. Okay, so what I'm going to present next is empirical results that are using real data to show that there are strategies in which you can use historical information to produce abnormal returns, which will be considered as that time as evidence against the weak form EMH. The first study I'm presenting is a very famous, probably one of the first, we call behavioral finance or financial anomaly evidence, published by Professor DeBont and Professor Thaler. Both are still professors nowadays, and Professor Thaler also won Nobel Prize a few years ago. Okay, and what they found in their 1985 and 1987 study, they show that actually if you look at past long-term returns, okay, how do they define long-term? Would be 3 to 5 year historical returns of individual securities. They find that past long-term winner stocks tend to underperform past loser stocks. So there's a reversal effect. Historical long-term winners started to underperform historical long-term losers. So the performance, the relative performance in the cross-section appear to reverse if we measure historical performance using past 3 to 5 year data. Okay, so why this is happening, right? They think this evidence is against the weak form EMH, right? Because they only use the historical return information. They can predict future abnormal returns. But what's the story? Why this is happening? Their interpretation is that investors tend to overreact to unexpected information. They tend to overreact to historical long-term returns, right? If they observe an individual security did really well for a long time, through 3 to 5 years, they tend to extrapolate that expectation into the future, think this stock will continue to do well, right? So they may become too optimistic about the future earnings of the security, and the performance, right, the business performance will tend to mean revert, which means the security going forward will tend to disappoint disappoint investors because the expectation was way too high, right, based on the historical record. At the same time, investors who have experienced a long-term losing stock, right? Long-term poor returns, they tend to become too pessimistic. And so their future expectation of earnings and the performance of the company will be too low. So the security will tend to outperform because it's easier to defeat a too pessimistic forecast. Okay, so this is their story and their finding. So how do they actually show this in empirical research? So this is something we call the CAR measure, the cumulative abnormal return, right? So we have learned the abnormal return alpha, that our Jensen's alpha in their setting is actually Jensen's alpha. They look at what they do is they look at realized return, but in this case, it's a little different from Jensen's alpha because they are calculating alpha for every single month, every single, I think every single day or every single month. And they use the realized return of the months minus the expected return of the months based on the market model, right? So market model is based on the CAPEX, right? So based on the market performance, based on the beta, based on the risk-free rate, this is how much the stock is expected to generate. And this is how much the stock is actually generating. And then they take the difference between the two, and then they accumulate that difference. Basically add them together for 36 months. Okay, the idea is let's go by the winner stocks. Let's go by the loser stocks. Let's look at how much they outperform their benchmark based on the CAPM, based on the market model for the next 3 years. Then let's compare their performance for that 3-year period on average. So this is what they see, right? They see that during this period in their study, and if you buy loser portfolios, the bottom 30 securities with the poorest long-term returns in the last 3 to 5 years, versus if you buy the winner portfolios, which is the top 30 stocks that have the best performance in the last 3 to 5 years, you can see that in the next 36 months, after you form your portfolio, you purchase them, and you lose the portfolios in terms of the CAR, right? Cumulative abnormal returns is significantly better than that of the winner portfolio, right? So the difference between the two is more than, it's about 15 minus 5 is 20, more than 20% in 3 years. Okay, so this is the way they show that the loser portfolio tend to reverse, do better than the winner portfolios in the next 3-year period. Okay, so this effect is called long-term reversal effect. Okay, and so the takeaway for the exam is to remember who did the study, right? Professor DeBont and Professor Thaler. What did they find? They found the long-term performance tend to reverse. Okay, so what's the definition of CAR, cumulative abnormal returns? What's their story to explain the finding? So what's the overreaction story? And finally, what's the implication of the finding for ENH? And their finding is contradictory to the weak form ENH because they show historical information can be used to forecast future abnormal returns. Okay, so that will be the conclusion of the first study. Long-term reversal effect. Any question? Okay, then I'm going to introduce you the second study, which is the short-term or intermediate horizon momentum effect. So this study was published by Professor Jagdish and Professor Titman. What they show is if you look at, instead of long-term returns, but if you look at most recent short-term or intermediate horizon returns, which is defined as 3, 6, 9, and 12 months. If you rank individual securities based on the 3 to 12 months returns in the recent past, they show that there's a momentum effect. Winner stocks, those who did well in the past, continue outperform the loser stocks, those which didn't do well in the recent past. Okay, so how long do they hold the portfolio? Once you rank the security, you have your winner, you have your loser, you hold them for the next 3, 6, 9, and 12 months. Okay, this is different from the previous study that ranked them based on 3 to 5 years and hold for the next 3 years. So this is much shorter horizon for evaluation and for holding. So the strategy they test used 1964 to 1989 data, and they show the strategy by buying the winner portfolio, the top 10% winner portfolio, and shorting the bottom 10%, which are the loser portfolio. They can earn an average 12 to 15% per year, which is huge, right? If you adjust risk, and you are going to get similar results, right? So basically, this is what they show. If you evaluate the portfolio based on the historical 3, 6, 9, 12 months returns, you do this long short strategy, and you hold it for the next 3, 6, 9, 12% month, and this is your average monthly returns, right? So if you look at this strategy, if you rank individual securities based on 12 months returns and hold it for 6 months, you're making about 1% per month in the next 6 months. So which is very sizable, right? And also some researchers have found that actually you get the best deal, the best return in the first 6 months. After going over the 7th month, the long short returns started to turn negative. Okay, so that's why we focus on this strategy, which is a good one, those strategies. Okay, so the takeaway from the study is, who did the study? Jagdish and Titman. What did they find? Did they find the short-term return momentum effect? And what's their story? Their story is people tend to underreact to short-term return information. If a stock is doing well in the past 3 to 12 months, and people tend to be too conservative to anticipate the stock to have good earnings down the road. So they don't change their expectation fast enough to incorporate the return information in the past, which resulted in continued outperformance of winners relative to losers. Okay, so this is a short-term underreaction, but the previous study is a long-term overreaction story, and both evidence is against the weak form EMH because both strategies used the historical information to produce abnormal returns in the future. Okay, any question before we move to the second set of tests? Okay, so I now have another exercise for you, because now we have presented some evidence that's contradictory to the weak form EMH. We're gonna examine the research results for tests of semi-strong form EMH. But before that, I just clarified this conceptual framework and using this question answer format, right? So which of the following observations appear to contradict the semi-strong form EMH, right? Semi-strong form EMH says historical and public information are in the price. They cannot help you to predict returns. So which of the 4 contradicts the semi-strong form? Okay, go ahead, read the question. I'm gonna create another question to do the poll, so that you can see so this is semi-strong form. You can enter your input, semi-strong EMH. Which one is against the semi-strong form EMH? So we have A and B and C and D. Again, this question is only one choose the best answer instead of multiple answer, right? So I'm gonna launch my poll to get your input. Okay, so go ahead. Tell me which one do you think is the best evidence against the semi-strong form EMH? Okay, so I can, I apologize, the last one should be D. If you're choosing D, go ahead, choose the fourth option. I apologize, I put in C by accident. Okay, wait until we have about 50% people voted. We have now 44%. So I need 2 more, then okay, we got 50%. Anyone else who wants to jump in before I end the poll? Okay, we got 60. Thank you so much for your participation. I assume the last one is the D. Okay, so we do have some people choosing the fourth choice. Again, I can tell you the choice is everywhere. Every option has selection by some students, and this is why this chapter can be conceptually challenging, even there's no single calculation question in the test from this chapter, but it takes actually a lot of time to get the question right. The best way to practice is actually read the chapter really well, do your homework, and also the end of chapters I assigned for you to review. Go ahead, review, and compare the question against the answer provided on Blackboard. Okay, so I'm gonna end the poll and showing you the results, right? So you can see that the results we have, most of those come from the B and C, the second, the third choice, and less from A and D. So I know A and D is not correct, but which one of among B and C is correct? So let's take a look, okay? So this question asks you which one contradicts the semi-strong form EMH? Which one is inconsistent with the predictions from semi-strong form EMH? Semi-strong form EMH says you cannot make abnormal returns using historical or public information. So B is incorrect, right? B says you cannot make abnormal profits using public announcements of earnings. That's consistent with semi-strong form EMH. That doesn't contradict semi-strong form EMH. So B is the right prediction, is not the one against it, but we are asking you to select the observation that's against the semi-strong form. So we know that C should be correct. Okay, C says you can use abnormal, you can use fundamental information, public announcements, which is earnings, right, to make abnormal profits. That's opposite, that contradicts the semi-strong form EMH. Okay, so why A is incorrect? Because we considered managers, mutual fund managers, to have private information. They do not outperform the market. That's supports the strong form EMH, but that doesn't contradict the semi-strong form EMH. Similarly, in D, in any given year, 50% of pension funds, professional investors, they outperform the market, the other 50 underperform. This is by random chance. It says nothing about who can make abnormal profits consistently over time. So it says nothing about alpha, so it's not evidence against any form of EMH. So only C is the best answer, okay? So let's move on to see the real data. So this is only conceptual framework and what kind of evidence we're looking in order to reject the semi-strong form EMH. As long as we find evidence that one can use fundamental information, public announcements to make abnormal profits, then we find evidence against the semi-strong form EMH. So the evidence I'm presenting includes 3. The first one is the size effect, right? It was proposed in the early 1980s by early 80s by Benz and Ragnan, two professors, but was later incorporated by Professor French and Fama's three-factor model into the size factor, but the original study was conducted by Benz and Ragnan. Right? What they show is that small companies do better than large companies in a risk-adjusted sense. Right? In their data, the size effect was huge. It's like 20% per year for like 40 years, right? Any question? Okay, so what you show here, we have data that's more updated from 1926 to 2008. You can see that small firms do much better than large firms. Okay, so that's size effect. Why size effect is using historical public information? This can be a little confusing. The way that the book defines is because size is price, right, times shares outstanding. Price is historical information, but shares outstanding is contained in balance sheet. Right? So it's considered to be the information announced by company. You don't have the accurate information until you receive the annual statement or quarterly statement from the corporation. So that's considered to be public information. Therefore, the size, the variable size itself is more like a fundamental measure of the company market capitalization. It uses both historical and public information. Any question? Okay, so what's most interesting about size effect, which was fascinating for me when I was a student getting to know this, is the small firms outperform large firms, not throughout the year. It just happens exclusively in January on average, especially the first 5 days of January, right? So this is evidence. If you look at the abnormal daily returns in the first 5 days of January, you can see small firms do way better than large firms. If you look at January, which is the red line, right? This is small versus large. 1 is small, 10 is large. It's huge difference here. Small firms do much better than large firms. So this red line is essentially this, right? But if you look at other months, the relative performance between small and big is very tiny, right? So I was using the slides from my former professor because I think this is the most fascinating slides for me. When I was a student, I said there's no way, right? Small firms do better than large firms. Only for 5 days, it cannot be risk. At that time, I was fully convinced that this is an anomaly. This is not a risk story. So that's the size effect. So the size effect is also called the small firm in January effect, because small firms do better in January and first 5 days in January. Right? So remember, the small firm in January effect is another way to call the turn of the year effect, another way to call the size effect. Okay, so that's the first piece of evidence showing historical and public information. Public information can be used to forecast the future abnormal returns. Right. So the second piece is also to do with later from a French model, the value effect, right? So we have discussed about the value effect, but actually the value effect were proposed by researchers prior to Fama French 1992. Basically, the effect shows that value firms, which are measured by various ways, any high fundamental value relative to market value, firms are considered to be value firms. In Fama French, they're using book to market equity, but you can use like EP ratio, earnings to price, or dividend per price, etc. In general, if we define value firms then versus growth firms, historical returns shows that value firms do better than growth firms, right? So this is what we find using book to market decile. The top 10 book to market portfolio do way better than the bottom 10% of portfolio, which are considered to be growth firms, right? So what's the story? The story is some researchers believe that investors become too glamored about growth firms. We pay way too much for a printing machine, right? So sometimes the question is, if you can buy a printing machine, how much are you going to pay for it, right? So then you instantly realize, oh, do I pay $1 for a printing machine, $2, unlimited? And that should not be your answer. The answer should be, okay, how much the machine can print it? How much money the machine can print? If the machine can print $1 million, if you pay $999,000 or for the $1 million machine, you get $100 or would be worth it. You get $1,000 would be worth it, right? So if you have a fantastic company, but if you pay way too much, you're not going to have stellar returns. So that was one of the explanation why growth companies do not give you high returns, is because people paid way too much for good companies. Okay, so their returns are not impressive at the end of the day. But if you pay too little for a poor company, you may end up having good returns, because poor company meaning their earnings are bad, but if you pay way too little, then you can still have good returns on your dollar, right? If you pay $1 to get something that's worth 10, versus you pay $1 million to get something that's worth $1 million plus $1, you're better off to pay $1 to get something that's worth 10, right? Any question? Okay, so this is the second piece of evidence showing that public information contained in valuation ratios, such as book equity, right, to market equity, and can help predict future abnormal returns. Again, this is evidence against the semi-strong form, EMH. The last piece of evidence here for semi-strong form, EMH, is called the post-earnings announcement drift, the PEAD effect. So this is a very, very famous financial anomaly, because still today you see people publishing articles saying this is still existent, right? It's proposed and published by Professor Bernard and Professor Thomas, and they look at what's the market reaction to earnings announcement. So how do you define earnings announcement? Is it good news or bad news, right? So they use the measure which is called SUE, the standardized unexpected earnings. So basically the earning announced relative to the consensus forecast by the analyst, which we call the earnings surprise. And it's standardized by certain methods. Okay, what they find is stock prices do not reflect earnings announcement instantly and fully. Instead, it takes 60 days or more for stock price to fully incorporate earnings announcement. Okay, so what do we mean by that? So let's first look at the prediction of the earnings announcement reaction under semi-strong form efficient market. So this is something we are supposed to observe if the market is semi-strong form efficient, right? Meaning that having public information would not predict future return, because the price will move instantly when the information is announced. But before the information is announced, this is an announcement, and the price may move based on private information, because the market is semi-strong form efficient, but is not strong form efficient. So private information can move the price over time, right? But once the information announced in public is going to move the price up for good news and down for bad news, then the price should stay there on average, no drift and no reversal, until new information arrives. Okay, so that's what we are supposed to observe under semi-strong form efficient market. But what do we observe in the real data, right? So if we look at the earnings across different level of surprise, we should see something here and stay here, something here, stay here. But what does the data show? The data shows no, that's not what we observe in the data, because the data shows the price didn't change fully, because it takes time for the price to change it takes 60 days, 90 days for the price to drift towards the direction of the earnings announcement at time 0, and to fully incorporate the information content of the news, right? Because we're supposed to see flat, right? That's not what we see. Good news, price continues to drift up. Bad news, the price continues to drift downward. And that's called post-earnings announcement drift. Okay, and that's a financial anomaly because you are not supposed to see this if market is semi-strong form efficient. This is saying investors underreact to earnings news. They don't incorporate the news on the day of the announcement. Instead, it takes them 60 to 90 days to fully recognize the impact of the news in prices. Okay, and so this is amazing results, which actually people find still nowadays. You see quite a bit of post-announcement earnings announcement drift, right? So at that time, the two researchers showed that if they form a hedge portfolio by buying the firms that have positive earnings surprise and shorting the firms with negative earnings surprise, and the quarter by quarter performance are here over their sample period, and they hold the firms for 60 days. You can see that this long short strategy performs extremely well. It has only 4 negative returns in the 13-year period, quarter to quarter. So it's amazing, right? And they definitely beat the market with this level of Sharpe ratio, because you don't really lose money most of the time. And when you do lose money, lose a tiny bit of money, not a huge drawdown. So this is a fantastic strategy. Okay, so this is again provides the evidence that's against the semi-strong form EMH. Having the information about earnings today allows you to make abnormal profits in the next 2 to 3 months. How amazing is that? Okay, but again, this is at that time it was quite new strategy, but this study has been published for 30 years, and some people find it sometimes it works, sometimes it doesn't work. So nowadays, and probably a lot of people know the strategy, so that it by itself may defeat the efficacy of the strategy nowadays. Okay, and you may come and go depending on how many people are using the strategy, try to make money, right? So this concludes our presentation for the semi-strong form EMH tests. And the evidence I present here, small size effect and value effect and post-earnings announcement drift, are all against or contradictory to the semi-strong form EMH. Okay. The last set of tests is the strong form EMH test, right? So we're going to look at whether having the insider information or private information allows us to beat the market. Of course, strong form EMH also says all information, historical, public, and the private information should be incorporated into price. It should not move the price in the future. So the question I'm going to give to you in my poll is going to be multi-choices, because we have 3 information sets, and which of the following statements appear to contradict the strong form EMH. So go ahead, read the questions. I'm going to rewrite and launch a poll. Enter as many choice as you think that's against the strong form EMH. Okay, I can tell you there may be more than one answer here. Okay, it can be a little fuzzy, so you have to go back, think about the definition of strong form EMH. Okay, which one violates the prediction of EMH? As long as you violate one prediction, then you violate the whole or null hypothesis. Okay, you do not need the evidence to violate all predictions. You just need one piece of evidence that violates one prediction from the null, then you can reject the null. So being the null hypothesis is really difficult because you have to defend yourself all around, all the way, right? Well run. Okay, again, I can tell you I see answers everywhere. Again, I have to remind you, read the chapter, do the homework, do the end of chapter questions, because the conceptual questions from this chapter can be very difficult. But it takes a little bit of training. Once you read enough, do enough questions, you will have the right choice. Okay, which will definitely, the type of question will be on the exam. Okay, great. I have 62% of you have returned, so I'm gonna share the results. Anyone who wants to jump in before I end the poll, go ahead. Okay, so I'm ending the poll and share the results. Did you see that? So we have everywhere, right? We have most of people chose B, but the rest, and E, but the rest are sort of evenly split. Okay, so let's see which ones are correct. First one, nearly all of the professionally managed mutual funds are able to outperform SP in a typical year. Again, if they are considered to be professional managers, they have private information. By random chance, some of them will outperform in a given year, some of them will underperform. It says nothing about alpha. Alpha has to be persistent, consistent across time. So it's not evidence against EMH, okay? Just by random chance, you will see that. How about B? B said we have money managers that outperform market in 1 year are likely to outperform next year. This one is correct because it shows consistency in abnormal returns. So someone has skills, they can consistently outperform the market, which is evidence showing professional managers, some of them have alphas, okay? Having the private information does help them to outperform. So B is correct because it contradicts the strong form EMH. Having private information, you're not supposed to make abnormal profits under strong form EMH, but this one said, yes, you can. C, stock prices tend to be predictably more volatile in January than in other months. So this one, again, this one says nothing about price and returns. So you can predict volatility, but it may not lead to alpha, abnormal performance. So it's not evidence against the strong form EMH because it's not return patterns, it's not financial anomalies. And D, stock prices of companies that announce increased earnings in January tend to outperform in February. This is return prediction, right? So if you have increased earnings in January, they tend to do better next month, then you can buy this company to make abnormal profits. So D is a correct answer, right? Using public information, you can make money, and that's against strong form EMH, that's against semi-strong form EMH as well, right? So last one, E, stocks that perform well in 1 week perform poorly in another week. So this is the short-term reversal effect in weekly return. And surprisingly, this is also a correct answer, right? Why? Because this E says using historical return information allows you to make abnormal returns. And that's against a weak form EMH. That's against semi-strong form EMH, as well as strong form EMH, right? So having evidence against weak form essentially rejects all the other form of EMH. So that's the tricky part, but the answer should be B, D, and E. Okay, so what we are going to do is to present a set of evidence and to see whether we can use historical returns to generate abnormal profits. It looks like I'm running out of time. I think I have to stop it here. It's already 6:45. I will continue next time to finish up the lecture, to do the review. Um, if we can't finish, then we'll continue next Tuesday to do the review. But I think we can definitely finish the lecture on Thursday, do a little bit of review, and continue the review next Tuesday. Okay. Any questions? Okay. So now I start to record the lecture. I'm going to continue with the slide I finished, we were at last time, which is the slide for the conceptual question regarding tests of strong form EMH, right? So the question asks you which of the following observations appear to contradict the strong form EMH. What I want to do is to launch a poll. I think probably we did last time, if you recall, but we can try it one more time. So this is, you can select multiple choices here. Instead of one, you can select more than one to be correct. And let's see whether you can recall the answer, okay? So the strong form EMH says both historical, public, and private information is incorporated into security prices and should not be used and be helpful to predict the future price movement or produce abnormal returns in the future. Okay, I can see that now. I think this time we got much better results because we have a lot of you. Of course, I still see answers everywhere, but most of the answers are in the right direction. So hopefully you recall what we had last time. So anything that violates the prediction that of strong form EMH, even you just violate one of the predictions, then it's contradictory to the strong form EMH. Okay. So I have 32% of you answered. Anyone who wants to jump in before I share the results of the poll? Okay, so excellent. I have 50% of you already answered. Can I end this, or are you still trying to join? Okay, probably one more minute. Okay, great. So I'm going to end the poll and share with you the results. Then we're going to quickly go over the results as a reminder. Okay, so as you can see that most people chose B, E, D, and some people chose A and C. Okay, so A is not the answer because by random chance, mutual funds who are considered to have professional investors who have private information, they will be able to outperform SP 500 in a given year. The other half will be underperformed. So this is not persistent and a consistent alpha, right? So this is not persistent over time. So it's not evidence of abnormal returns being made based on certain type of information. So A is not a piece of evidence. B is correct, right? Because B says money managers that does well in 1 year tend to do well next year. It shows the persistence in the performance of professional managers who are considered to have private information. So this is evidence against the strong form EMH, because under strong form EMH, no one can use private information to make abnormal profits, and this is evidence is contradictory to that prediction. C is not the answer. The reason is stock price can be predicted based on the volatility, right? I'm sorry, stock price volatility can be predicted based on the calendar time. It's nothing to do with return predictability. It doesn't imply automatically the alphas to be made. So it says nothing about the financial anomalies and abnormal returns and alphas. So it's not evidence against the EMH. And D is the correct answer because D says that using earnings information, which is public information, can help you to predict the returns in the following months in the future. So that's abnormal returns using historical information. So that's against semi-strong form EMH as well as strong form EMH. So lastly, E is also the answer because E says some technical trading rules based on historical return can help you to predict future returns, earn abnormal profits. So this is evidence against the weak form as well as the semi-strong form and the strong form EMH. So once you find evidence against the weak form, and you are going to find evidence, this is automatically the evidence against semi-strong form and strong form EMH. Okay, so this is only conceptually where do we look for in order to find evidence refuting the strong form EMH. But let's look at the data. What does the data say to us? So finance research have focused on several kind of tests, right? So to test the strong form, of course, the weak form and the test of weak form, semi-strong form are helpful, but specifically for strong form EMH, it says even you have private information, it's not going to make you abnormal profits. But is that true? Can we look at market participants who have private information? Let's look at whether they can make abnormal profits. So who has private information? Of course, insiders, right? Executives, employees, whoever works in the company who have access to insider information. And also analysts, right? Analysts does a lot of research, talk to the CEOs, talk to the company, do a lot of survey, do a lot of investigation. So they may have private information. And also professional managers like mutual fund and hedge funds who does a lot of research and come up with information that other people don't have, right? So can they make abnormal profits using their information? If none of them can, then we find evidence supporting EMH strong form. But if we can find any of them actually are able to use private information to generate abnormal profits, then it's evidence against the strong form. Okay, so this is going to be our test to focus on those market participants who have private information, look at their performance, whether they have generated superior or abnormal profits performance over time. And I can tell you before I show you the results that the evidence is mixed. So some evidence, most of the evidence saying no, they're not going to outperform, but some evidence saying there are stars, there are certain group of those professional investors or insiders who can make abnormal profits. Okay, so this is somewhat mixed results. Okay, the first study was an earlier study by Jiang, 1986. So he looked at abnormal returns following insiders buy versus sales of her own company stocks, right? So if a CEO sold a stock, is this good timing, right? He sold the stock at the top before the future decline of the price, or he purchased the stock at the bottom before the future appreciation of the stock prices. So this is what Jiang found, which is indeed after it looks like the CEOs has the perfect timing, because when they sold the shares and subsequently on average share price decline. It doesn't happen to every case, but on average you see that pattern. When they purchase the shares, subsequently the share price appreciate. Again, this is on average, it doesn't happen every case. And so this initially was considered to be evidence suggesting having the insider information allow you to make abnormal profits, right? But some people also argue that it could be that they actually didn't report the right date, right? And especially for options, there's an argument about the back date the dates of exercise or the option grantee, right, in order to have a better profits. So this seems to be evidence of suggesting insiders make abnormal profits, but there's still some caveats in terms of interpreting the results. So that's our early evidence. Let's look at newer evidence, right? So newer evidence, I'm going to introduce this article actually published later after 2012 by Cohen, Malloy, and Pomorski at Harvard University. So what they did is, okay, can we identify insider trades, not everyone's trades, but trades by insiders that's not routine. That's something not they don't do all the time. Does those trades or those trades containing information for investors to profit based on the information reviewed from insider trading? So they classify insider trades into two types. One is they call the routine trades. If the insiders consistently buy and sell in the same calendar months in the last 3 years, maybe they have to pay for a Christmas gift, or maybe they have to pay for tuition of the children. That's why they have to liquidate shares in every year, a certain month. And that type of trades are considered to be routine and considered not containing optimistic information. The second type of trades, which is other trades that's not routine, they call them optimistic trades, because those trades may reflect the motivation of insider trading. Okay, some people may ask me, oh, why can insider trade? They can trade, but the SEC rule is they have to file a disclosure of their trades within 2 trading days, maybe 2 or 3 trading days after their trading. And they cannot trade before major corporate events. So insider trading are not always illegal, depends on what's the motivation of the trading, what's the information environment, and as there's additional disclosure rules for all trading done by insiders from SEC, right? So what did the study find? The study shows that if you follow optimistic insider trades, you can actually make abnormal profits. So you don't need to do exactly what they did. You just follow them after they file the disclosure, and it becomes a public information. And you can access that information, and you follow that information. You can actually also make abnormal profits. Of course, the insiders who move before you do actually can make even better profits. So this is their results. So their strategy is to buy following the optimistic insider buy trades and sell or short following optimistic insider sales. Okay, they do the value weighted portfolio. They show the alpha is nearly 10% per year. Okay, so what is this? So this blue line is the optimistic long short opportunistic trades, to follow the trades, right? And minus the routine trades, okay? And the blue line is the opportunistic buy and sell strategy, right? You buy those who optimistically buy, and you short those stocks with optimistic sale trades, right? And you get the blue line. If you follow the routine trades instead, you actually lose a little bit of money, maybe statistically insignificant. So the routine trades do not contain information about future price movements. So the best trades you may have is actually follow the opportunistic long short, but actually short the routine long short, right? You get the distance between the green and the red line, that's your blue line. So taken together, this chart and the study shows that insider trades, if you can identify the opportunistic trades, it does contain information for future price movement, and you can indeed make abnormal profits. Okay, so this evidence then support, okay, having private information can make abnormal profits, which is against the strong form EMH. Okay. But in general, if you look at professional investors, right, where we're talking about insiders, but if you follow mutual funds, unfortunately, most of the studies so far have shown that mutual funds on average do not beat the market, right? So we have here is a study in 1993, and this kind of study has been repeated by many studies, but in general, you actually don't see a positive and significant alphas for mutual funds. In general, they tend to have negative alpha because if you count for the fee and the alpha counts for the fee, and some cases, then a group of mutual fund may have negative alpha, right? So this is a multi-factor alpha. So we do not find evidence in general that mutual funds as a professional investor group outperform the markets on average. But some do, like when we mentioned the Peter Lynch, Magellan funds, it indeed outperformed during Peter Lynch's tenure. Okay, and also mutual funds performance do not persist, right? One way you can look at that is you sort performance, right? We talk about the stars, right? Morningstar, basically risk-adjusted return of mutual funds into the top performer versus the bottom performer, 10 groups, deciles. Then you look at their future ranking of the same portfolio, same mutual funds. You see that the ranking doesn't persist very much over time. A little bit maybe at the top and the bottom, but on average, they tend to, over a course of 3-5 years, they tend to cluster, become the mean. So that performance is not persistent over a long period of time, potentially because the fund is growing, the manager was lucky at this time, and the manager, there's a turnover, right? So in general, we do not find evidence that mutual fund or professional managers exhibit persistent skills in generating alpha. And that's similar to hedge funds too, right? But on average, hedge funds do not beat the market, and in certain period in the last 10 years, they are beaten by the market on average. But indeed, there's some superstars that appear to deliver alphas, but that's rare cases, right? Some cases. Okay, so taken together, what's the implication of the test results, right? We present a bunch of evidence showing that there are ways to use historical, public, or private information to make abnormal returns. Oh, okay, do we take as granted that those evidence refuting the EMH, right? So we're going to talk about the caveats in terms of interpreting those we call financial anomalies or anomaly results. Right? So Professor Fama has published a paper in 1996 and other years, and talking about we always want to be careful when we interpret alpha, right? Why? Because the alphas are estimated relative to a benchmark model. In most cases, we use the CAPM, the single factor with a market model. And sometimes we use the Fama-French 2-factor model, 3-factor models, and now we're using Fama-French 5-factor models and 4-factor models. And we always assume there is a perfect model to determine the expected return and risk premium. So it's always a joint hypothesis problem, because we could have the wrong model, so we generate alpha, or could have the right model, so we generate the true alpha, right? So our alpha can be the true alpha if the model is right, or it can be the fake alpha if our model is missing some systematic risk factors, because the alpha could be the risk factor premium, right? So this is what Professor Fama talked about, the bad model problem. You can never know whether your alpha is the true alpha because you never know what is your right model. Okay, so just keep in mind that could be a possible explanations for the alphas. And also, second criticism by many researchers is that we may not have the right factor, right? Even our theory shows there may be 1 factor, 3 factor, 5 factors, but all the factor returns and premiums are proxies, right? Such as we use SP 500 or the total market index to be the market factor, but the market factor is the value weighted index incorporating all risky assets, not just the stocks, right? And we don't have an index that incorporates everything that's tradable, risky assets. So we always use the imperfect proxies for the risk premium or the risk factors. So we could have a misrepresentation or tracking error that caused the emergence of alpha, which may be simply due to we used a bad proxy. So that's a second potential criticism or alternative explanation to the results. So the third one is getting more popular, which is called the data mining hypothesis. This is now emphasized by the AFA president a few years ago, Professor Cam Harvey, and he is talking about the p-hacking. So what does that mean, right? If everybody is working with the same database, the CRISP database for the last 50 years, 60 years, and we dig deeper trying to find patterns. Then we find patterns based on previous pattern other people find. So by mining the data, we are going to find some patterns that hold well for this sample because we have dig the data so much. But it may not hold for a future sample because it could be just appear by random chance that we didn't have enough long time series of the asset trading history. So don't take whatever strategy for grounded thinking. It works in the sample, then it should work out of the sample. It works in the past and it should work in the future because it could be just data mining exercise, right? Other people also mentioned that it may, even if it's not data mining, by having the knowledge that some variable predict the return, and many arbitrageurs are acting to try to arbitrage that phenomenon by itself can basically eradicate or eliminate that financial anomaly, right? So in the past, people don't know it works. So if you know, you're the only person know, then that might, you can make up no profits. But if a lot of people know, they try to crawl in to trade the same strategy, the price will move now, not in the future, right? So that's alternative hypothesis. So, but at the end of the day, if those anomalies are true anomalies, they do represent mispricing and marketing inefficiency at that historical period of time, then the interpretation for those findings lies on behavioral finance, right? So behavioral finance consider that investors are not perfectly rational. They make mistakes. They make sometimes systematic mistakes that's predictable, which generates inefficiency and predictable return patterns. And so if you can understand the behavioral biases and cognitive constraints of investors, if they repeat those mistakes in the future, you will be able to identify arbitrage opportunities and make abnormal profits. Of course, this comes with a lot of premise as well, right? Limits of arbitrage, people, we do have humans trade in the future, not machines trade in the future, so on and so forth.